Hi and welcome to our first official version of the Valuation Dashboard presentation series. What the Valuation Dashboard is a compilation of charts every week running through a whole bunch of different asset classes, everything from international equities to Aussie equities, corporate bonds, Australian bonds, residential property. And the idea is that there's probably about 50 or 60 charts at least that we produce, and a lot of these charts don't change from week to week, but within each week there are a number of charts that do change and are particularly interesting. So what the intention is that this will sort of highlight some of those charts for us. So firstly, just running through the events of the week, we've seen the ASX down a little bit, small odds off 3%. In Aussie dollar terms, most of the international markets are up. China's actually up around about 6%. Japan and the US, a lot of that is the effect of the weaker Australian dollar, but nevertheless, China has outdone the change in the dollar there. In contrast, we've seen corporate bond yields down almost 17 basis points, and I'm actually going to highlight that. I'll go into a bit more detail in that a little bit later on a different chart. In Aussie bond yields, government bond yields, we've seen the bond yield continue to fall over the week, and this is a trend that's been certainly over the last 6 or 7 weeks. However, at the moment it was a lot steeper in the 2-year rather than the 10-year, with most of the damage has been done at the 10-year end over the last few weeks. One thing I should highlight with this one, the 12-month forward EPS, which we expect to be rising over time. It's as 2012 gets a little bit closer, or 2013 gets closer, you gradually expect this number to be rising over time as EPS growth is usually positive. However, what's interesting to us is it hasn't actually fallen over since sort of April, May, where we would have expected that the higher Aussie dollar would start to see some downgrades coming through to numbers, and given we haven't seen any just yet, my suspicion is that, or we haven't seen any significant downgrades just yet. My suspicion is that we're probably not going to see this in full until reporting season, when companies actually come out and analysts start to look a bit closer at their 2012 numbers and realise, I think, that we've got almost 19% growth for industrials factored in consensus earnings. That's a bit high. Other thing to note, the 12-month forward PE now down to 11 times. That's the weighted average PE. So now going into a little bit more detail about this BBB bond yield, we can see that at the start of this year, the bond yields were close to 9%, and if I compare that to equity dividend yields at the same time, we're talking about dividend yields of about 4.5%. So a big turnaround in terms of that, and the gap between them has shrunk significantly, which says to me two things. Well, first of all, that equities are a much better relative value now compared to corporate bonds than they were earlier on in the year. But the other thing it also says is that 2012 earnings, well, there's probably not a lot going to be, if we maintain these lower rates, there's probably not a lot of pressure on the interest expense line. Jumping then to the government bonds versus equities, where we have the 12-month forward PE, inverse PE, less than 10-year government bond yield, so basically the higher this ratio is, the cheaper equities are compared to bonds, and we're seeing that at levels really not seen since the GFC. Now, having said that, there's probably some, we think earnings are a little bit overstated in terms of this, but even still, if you knock off, even if you knock 10% off the earnings, you're still looking at numbers that are going to be very cheap in terms of relative value. Going back again to the PE ratio for the market, now we're looking at the ASX 100, and what we're looking at here is that we're starting to see a convergence of the median, which is now down to 11.9, and the average 11.1. Now the average is a lot lower because of banks, BHP and Rio, but that gap is certainly closing over the last little bit. Turning to small cap PEs, and we see, well, there's not a lot of difference at all in terms of the average and the median in small cap PEs, but also those PEs are very close to the large cap PEs. So if we look down a little bit lower, we see the difference between small cap PEs and large cap PEs. Now, we usually expect that to be somewhere between 1 and 2 times, or a little bit closer. And so we can see small caps, certainly for a risk-off period in which we're in now, aren't particularly cheap at all.